So this video is on the consolidation of financial statements. This is defined by the standard IFRS 3 and 10. Both will give you the rules of consolidation. Well, how do you know that or when does a company consolidate? What are the rules that cover the consolidation of financial statements? Well, let us explain just a bit before we actually look at an example, because it is those rules that are defined by the standard that will help us to even answer any question on consolidation. Well, according to IFRS 10, the standard, it states that when you're consolidating, the parent company must have control over the subsidiary. What do we mean by parent and subsidiary? Because a parent company is like the larger one that has maybe smaller other firms that are under it. Okay, so that's what we mean by that. We can give an example of maybe Zambif has their main firm, then they've got other outlets almost all over Zambia. Those are what we would call subsidiaries of Zambif. So in our case, we were talking about control. How do you know, or what do they mean by control? Well, according to IFRS 10, it says that for a parent to have control, it has to have power over the investee. That's the one rule. Controlling all the voting rights, and in that case, you can tell that this company does for sure have control. But how is control also expressed in terms of percentage too? If the parent company owns what? Greater than 50% of the subsidiary, then there is control there. And this is the basis for consolidation. Make sure that the parent owns more than 50%, then you can consolidate. So in this case, if it's below, what do we do? Then you cannot consolidate that question. It's very simple, just like that. This is why this is the very most important part of consolidation. Yeah, so let us now look at the steps that will help you consolidate and the standards on how they also define the other things. So the first thing in consolidation is what they call a group structure. Okay, so when you look at the group structure, it should just basically show you how the control is. So you can maybe say the parents, and we'll call S as the subsidiary. So we can do something like this. On this line, it's just basically showing the relationship between the parent and the subsidiary. And then you can say, okay, if this company owns 80%, you even say 80% owned. That's how you write it. What about the 20? What does it go? Because they do not own 100%. So you have to also show what does the 20% go. You can just direct it this side and say this 20% is in relation to non-controlling interest. We'll talk about it very soon. It's also a working that is required when consolidating. We'll talk about it soon. But just know that when you're writing the group structure, first the question will tell you, okay, the parent owns 60%. You even write it on the first line, like put this 80. Then once you know 60% is owned, then you'll be like, oh, what about the 40? The 40 will go to non-controlling interest. This is like the first working. You have to show this. You can get your marks just like that, and then you now move to number 2. Second working. What do we take on the second working? Net assets. Net assets. What do you understand by the word net assets? Net assets are basically total assets minus liabilities. Total assets minus liabilities. That's what net assets is equal to, which can actually be equal to share capital plus reserves. Share capital plus reserves, basically. And this is in fact the one that we'll be working with a lot in our consolidation of financial statements. This one, which I'm just circling in red, because that will be our prime focus. This topic will work mostly with share capital and reserves, because what is made up of reserves? You have share premium, you have your retained earnings. So that's what you'll be looking at here. Yeah, so we didn't finish the opening statement. It's net assets of subsidiary. Get this point clear. Subsidiary. Only the subsidiary. Nothing else. Not the parent company, no. of the subsidiary. So there are some ways that you can be calculating your net assets. This is the approach that should be required. So when you're calculating your net assets for this subsidiary, you should have two columns, like you can say a part for acquisition, and then you should have another column where you have reporting dates. So basically what we're doing here is that we'll be calculating the net assets at acquisition and at reporting date. So like I told you, what do we said we'll be using share capital plus reserves. So what you can list them: share capital, I'll just abbreviate. Then reserves, we said they can be retained earnings, share premium, like I told you earlier on. Yeah, premium. Then you'll be able to list some stuff there. There are figures. Okay, the question would tell you something about, oh, the share capital. Okay, was this amount? But usually the share capital, you would find it that share capital doesn't change. So whatever is presented to you in the statements of financial position in the actual question, that would be your share capital both at acquisition and at reporting date. Same goes or applies for share premium. But for retained earnings, most of the time they would tell you in the adjustment somewhere that okay, the retained earnings on the date of acquisition were so much. Then that's the figure you put under the acquisition column. Then they also then now there will be a retained earnings under the financial statements, but specifically for the subsidiary, because as I said, your focus is only picking stuff for the subsidiary, not for the parent. Because when they're giving you financial statements, you'll be seeing one side for the parent, the other side is for the subsidiary, but focus on the figures on the subsidiary. So all those things that we're talking about at reporting dates, basically these you'll be picking them from the financial statement that will be produced for you in the actual question. So they always give you a financial statement in the question because it is from it that you're going to consolidate. Yeah. So basically you have such, you put them, you also put that, you put that. Then finally you get the totals. By the way, this is very important. Get the totals there first. Then the difference of these two. The difference of these two gives you what? This is what they call post acquisition profit. Take note of this word, it's very important in this consolidation. Post acquisition profit, very important. The difference of the two, the total for reporting date and the total for acquisition date, is what they call post acquisition profit. Yeah, let's get that straight. Third working, goodwill. What is goodwill? This is the value over and above the cost of what's this? An entity over and above. So basically, we're looking at that value that is more than the value of its net assets. You know, when you're valuing a business, we value it at its net assets. Do you know why? Because the reason is that you have assets, you also have what? Liabilities. So the best thing is to have the proper accurate value of a company. You should also less all its liabilities, such that left amount, which we can now call net assets, is the proper value of a company. So now that value over and above the net assets total is the goodwill. That's the definition. So basically that's just an intro to just telling you what goodwill is, just in case you might be doubting or have forgotten in your financial accounting. So how do we calculate goodwill in this consolidation? Well, we get what they call purchase consideration. What do they mean by this word, purchase consideration? Purchase consideration is basically that investment that you have put into your subsidiary. You'll be given something in your financial statements. They might just give you, under the heading non-current assets, you'll find something like investments, and then there'll be only a figure on the parent's column. Then what do you do with that figure in the parent's column? But when you look at the subsidiaries column, there's nothing under the line of investments, meaning that figure that's showing in the parent company as investments is the purchase consideration itself. That's the one you pick and you replace here in the working. Then what do? Then you're supposed to now subtract from net assets. I'm going to repeat this pointer. So you get the purchase consideration, which we said will be written as investments. Then you're going to now less net assets. Net assets, take note of this. We've already talked about net assets, but which net assets? Net assets at acquisition. Why not at reporting dates? One might ask that question. This is because goodwill, as we said, it's the value of an asset it's the value over and above the net value of an entity at date of acquisition. So it's the time when you are buying, not the day you are reporting. No, that's why the acquisition date is very key. and that's why it's at acquisition, because that's how this actually does make sense if you understood what goodwill is. So you have to list net assets at acquisition. Suppose they tell you the parent owns 80%, like the way we studied in our example. Are you going to get the total net assets at acquisition? That's total. You're just going to pick it and put it here? No. When they tell you you own 80%, just get that same 80% of those net assets at acquisition, not the entire 100% of those net assets. No. So you look at the group structure. It's very important, because you might end up charging the whole 100% when the parent just owns how much? Just maybe 80 or 60. That's the point. So the difference of the two gives you goodwill. If there's impairments, I'm sure by now, for you to be doing advanced financial reporting, you must have done the standard IAS 38 in IAS 36, I beg your pardon, which looks at impairments. So mainly, if there are impairments, just subtract them from the answer that you find as your goodwill. Then that's it. Because everything, when there is impairments, just like depreciation, you have to just remove it, and you get that net value to value it. The fourth one is what they call non-controlling interest. Now this part has reached the one I said I'm going to come and talk about it. Now looking at the fourth working, which is non-controlling interests. Non-controlling interest. This one specifically, as the name has put it out, this is just that part of the control that is not, this is just that part of the company's control that they do not own. Okay, just that part of the company that they do not own. So as we said, if you have 80% owned, meaning that 20% goes to what? That's what they call non-controlling. Yeah. So it used to actually even be referred to as minority. Sometimes you might see this maybe in your exams just to confuse you, but it's the same, non-controlling interest. Yeah, or minority interest. So this one, the way it is that you look at that same portion that is not controlled, and you have to make a working for it. So we remember we have been calculating these things, the percentages of the net assets at acquisition. So there are two approaches actually for this one. You can use the proportionate method, which I'm going to explain. When you're looking at the proportionate method of calculating this, so for the proportionate method, you need to get the percentage. Okay, you get a percentage of net assets at acquisition. Okay, that's this format. At acquisition, you get a percentage. Then what next? At share of post acquisition profit. Okay, so basically that's that. You have to first get a percentage of the net assets at acquisition. Take note of this one, at acquisition. Then now you can add the share of your post acquisition profits. All right, there's another method that they call the full value method. Yeah, the full value method. In that one, what you usually do is that they would have given you, or the fair value method as well, that in that method what they do is that they will give you the fair value of net non-controlling interest. It might be stated in your adjustments as the non-controlling interest was, the fair value was so much. You can get that amount and then just come and add this share of the post acquisition profits. So basically what we're just trying to get at is that there are two methods for getting the same non-controlling interests. That's something to remember there. All right, then finally you go to the fifth working, which is what they call group retained earnings. Group retained earnings. What do we do this? As the name has put it, go to retained earnings. It's recorded there in your financial statements, but specifically for who? The parent company. Just like under net assets, we look at the subsidiary. Here, when you're looking at group retained earnings, it's just for the parent. So go to the financial statements. You will see the word retained earnings there in your statement of financial position. It's there. Pick it out and put the figure here. The whole amount. Don't you get a percentage, just the whole amount. Then add a share of post acquisition profits. I'm sure you've been seeing a share. How do you get the same share? I'll explain. We said post, sorry for that. That's post acquisition profit. Yeah, post acquisition profit. Yeah, mainly that's that. So this share, as we said, you go back to the group structure. The group structure gives you how everything will be shared equally. As we said, if the parent owns 80%, meaning what share will he get? The parent. The parent will get 80 of whatever profit will be found. Non-controlling interests in that case will get the other 20. That's how it works. So basically, these are the 5 most important workings to consolidate. The other standard, IFRS 3, just mentions that we need to get to offset or eliminate uh, intra-group items. We'll look at them as we further develop more videos on this same particular topic. But intra-group items, things that are bought within the same entity, those are supposed to be offsetted or eliminated. Yeah. Then IFRS 10, the same one we'll be looking at. This one says we need to combine like items, assets, expenses, liabilities. We combine them. If the parent has 10, the subsidiary has 15 on its assets, just say 10 plus 15, 25. So total combine. So this standard says. So basically at this point, then now you go and prepare this statement of financial position according to what? IS 1. As again, at this level of advanced financial reporting, you should have already known this standard by heart, how to prepare financial statements. So then now you prepare them after all those workings have been done. The only thing that you just need to remember is that when you are putting things that in your financial consolidation, make sure you've done your workings first and you get through again to just put the figures. So let's have a short example so that at least we grasp this intro. So they have told us that the following statements of financial position were extracted from the books of 2 companies at 31st December 2009. Okay, so we have the following, as you can see. Current assets. This is basically a financial statement for you. Given this specifically the statement of financial position, like I was telling you, they will give you. Okay, they will give you a statement there. They might be both the income statement or the statement of profit or loss, and this one. But in this case, since we're just doing the intro, just having something short to grasp the consolidation part. Then we start. We have our current liabilities. They're saying Derek acquired all the share capital of Clive 1 year ago when the retained earnings of Clive stood at 2,000 on the day of acquisition. Goodwill is calculated using the proportion of net assets method. Remember those 2 methods? This one is the first one that they've mentioned. There has been no impairment of goodwill since acquisition. Prepare the consolidated statement of financial position of Derrick Group as at 31st December 2009. So we need to prepare, but as we said, before you prepare, do those workings. It's the first thing. So how do we do the workings? They've told us something, and the first working is group structure. Let's just analyze before we go to the workings. They've said something that Derrick acquired all. When they say all, they are telling you that they own everything. If they don't own everything, they'll tell you that, oh, they just have this portion. So all means 100%, and we know that our group structure will be 100% for the parent to subsidiary relationship, and let's show that. And then we'll come back for these certain figures as we go to the net assets working. Like I told you, you go to net assets. In this case, we look at what? Share capital plus reserves. So we have share capital already. We have the reserves such as share premium, and we have retained earnings like we mentioned. So these figures you're seeing in the financial statements are at reporting date. Like I said, you have to understand that these are at reporting dates. Then the retained earnings is the one you just have to be careful about, because there's that part for acquisition. Only on retained earnings you need to look out for the acquisition which is given, where in the additional information they've said 2,000, so we need to come and record the 2,000. While the others, we maintain acquisition and reporting are the same for share capital and share premium. Let's go ahead and first answer this. So let's just go back to the group structure. That's the first working. they own the entire 100%. Like I mentioned, they've just said, oh, all the shares, then that's how you know that's 100%. The next one is net assets, but for the subsidiary. Remember what I told you? Go to the financial statements and look at what they put under share capital, because whatever they put for the subsidiary under share capital, both at reporting date and at acquisition is the same. So there was 4,000 recorded in this subsidiary person, who's Clive. If you want to be specific, just in case you're doubting, Clive is the subsidiary. Okay, then 4,000. Share premium also is the same for the reporting date and acquisition, but retained earnings, careful on that one. Go to the additional information where they said 2,000 date of acquisition, so that's why I've put it in the acquisition column. Then we have the 9,000 this side, which came from the reporting date on the financial statements. Then we summed up, like I said, sum up for both sides. We got a 12 and we got a 19. The difference is what we call post acquisition profits. Just remember from what we did. You can even rewind the video. And after this, what next? Got the third working, goodwill. Well, if you rewind the video and go back to the question, there's a part labeled as investments, which we actually just call purchase consideration. So first you label this as goodwill because that's the working we're looking at. Then we say that's called purchase consideration. Whatever is labeled as investments, and that figure seated in Derek's column. So purchase consideration, as I said, that's investments that is basically shown in the parent side of the financial statements, which in this case is Derek. You'll notice that when you rewind, there's a figure 27,000. That's the amount. Then what did we say? You're supposed to less net assets at acquisition. At acquisition, just be abbreviating some of the words. Net assets at acquisition, or how much? Go back, working 12,000. The sum, we said get the summation because that's the total net assets. So even puts 12,000. There, the difference is what? 15,000. That's basically your goodwill. There was no impairment, they told us, so we just skip. Working number 4 is what? Non-controlling interest. Do we have non-controlling interest in this question? No. This person Derek, the parent company, owns everything. Or in this case, we have no non-controlling interest, so you can skip the working. Can we go to working 5? Like we said, it's just an intro video. There will be some questions that will have this working done, so that you can even appreciate it further. 5 is group retained earnings, which is finally going to be concluded as follows. Like we said, go to the financial statements and pick under Derek, the parent. They said it's supposed to be parents retained earnings. That's how we record this, parent retained earnings, which is how much in the financial statements. Again, when you rewind, you will notice that there's supposed to be 40,000 under Derek's column for retained earnings. Then we said you're supposed to now add a share of the profits, the post-acquisition profits, which in this case it's everything because they own everything. I hope you get that. Share of the post-acquisition profits, I've just abbreviated that, which is 7,000. So they'll take the whole 7,000, which is 47,000 for group retained earnings. Thereafter, we can now consolidate. We've done all the 5 workings, so we can now consolidate. How do we consolidate? Basically, as we said, this standard Ifrs 10 tells us that combine the like items, non-current assets for the parent and subsidiary, add them together. Current liabilities for the subsidiary and the parent, add them together, just like that. That's what we'll be doing basically. So let me just show you an overview of the statements again, then I will now show you the outcome of the consolidation. Well, so this is the question first. I just wanted to show you the question yet again, so that before you see the solution, you see where the figures will come from. So like we said, like items, you've seen property, plant and equipment. So you've seen both on Derek there's something, on Clive there's something, there's 75 and there's 11, so just add the 2, giving you 86. That's what you're going to just record one figure. Don't go and show the addition of 75 plus what, no, just show the actual figure. Investment in Clive, the one I was talking about, they'll even say investment in the subsidiary's name, so you can know that this is the purchase consideration like we've been talking about in the video. That's how it's usually stated. Share capital, the current assets is just a block figure, 214 and 33. You just add the 2. Okay, the other one, share capital, there's 80,000. So even as you're recording, take note of this. What about share capital? Are you also going to say 80 plus 4? No, The share capital we only maintain for the parent. The other one, share premium, only for the parent. Yet again, retained earnings, we take group retained earnings. These are just things you need to take note of. Under the equity section, you have to be careful. Share capital, take for the parent. Share premium, take for the parent. Retained earnings, get the group retained earnings, the one in your working number 5. That's the one you put as retained earnings, you record it. So it was how much? It was 47, if you remember. That's what I'm going to show you in the next solution. So let's have a look. Well, basically that is our consolidated statement of financial position, specifically because we had an example on the statement of financial position, and that's the one we're just demonstrating on how to consolidate. So there'll be other videos for the income statement and the like, but those are the rules, the ones stated, the 5 workings, very important when you're consolidating your financial statements, and for the financial position specifically, in fact, as well. So you can see it has been balanced with 348 both sides. So that's basically the format and an intro to consolidation of financial statements.